Hello and welcome to the Silverfern April 9, 2020 webinar. My name is Clive Holmes and I am the Managing Partner of the Silverfern Group. Today we're going to give you an update on our views of the global market post the COVID-19 pandemic and what we are seeing in each of the local markets in which we operate. As many of you know, Silverfern's senior core investment team has invested prudently and successfully through three major downturns similar to the events that are unfolding with COVID-19. We believe that we are deeply experienced in identifying businesses and companies that are undervalued or have been unfairly downward valued in the light of the asset pricing adjustments that necessarily occur after an event such as this pandemic. And of course, how to capture that value gap for our investors. Accordingly, we felt it might be of interest to hear from members of our team around the world what they are seeing on the ground at this time. Of necessity, we're all working from home at the moment, but we're staying very close to our portfolio investments and also to other market participants in the field. I'm going to be calling on team members from around the world today, from Western Europe, from the Americas, and from Australia. So you're going to get a truly global picture of what it is that's going on. To start the conversation today, I'm going to call on Robert Spittler. Robert is a Managing Director in our Frankfurt office. And Robert, give us some perspective on what you're seeing in the German market with regards to deals today.
Thank you, Clive. So, first of all, it seems that Germany is getting through all this relatively good from a health perspective. From an economic perspective, it's not really that black and white. Sectors are impacted differently. So there are sectors like retail, healthcare, pharma that have obviously benefited. Hotels, restaurants, entertainment had a disastrous time, and all other sectors are basically somewhere in between. A lot depends on the upcoming weeks and the process of the restart of the economy. We're all kind of uncertain about how this will go. From a deal and transaction perspective, I think everybody is in a waiting mode and waiting and getting ready so that when the transaction window opens again, that you're prepared to be part of those transactions you really want to play in. I also believe that the M&A activity we have seen before the COVID-19 epidemic came to a full stop. So here in Germany, we saw high multiples, high leverage ratios, 7 times EBITDA, that double-digit multiples. The word was 12 is the new 8. And I think that is really gone, and we will not see that in the near future again. And it is really an inflection point. Every day I'm in contact with our local partners and industry experts, and the message is the time is really there for the Silverfern strategy to opportunistically exploit the opportunities that are created by these events. So I really believe this will create a lot of opportunity, but those are hard to find, and you really have to be active in the local market.
Okay, thank you, Robert. Now I'd like to call on Alex Zucker, and Alex is a Managing Director also in our Frankfurt office. And Alex, perhaps you can give us your views on really what are the key concerns of local investors during this time.
Sure, Clive. Thank you very much. If you look at public markets in Europe, they have just about made a full recovery over the last 4 weeks or so. However, they are still approximately 25% below the peak in mid-February around that time. So the conversations we had over the last weeks with investors, as well as our SAB members, strategists from outside, hedge fund managers and other GPs, all in all a very broad measure of investors as such, paint a picture of 3 different cohorts of investors so far in this COVID-19 crisis. I think it's fair to say that cohort 1 is outright scared because they either have no or had no long-term vision, or, and that's even more likely, were not at all prepared for such a fundamental event. they are in pure panic and liquidation mode, still today. The second cohort, or cohort 2, was somewhat prepared, but is entirely busy addressing their existing investments, both in private and public markets, and take a perspective very much driven by the current volatility and uncertainty. They neither find the time nor have a compass to look beyond this imminent crisis. Finally, and interestingly, Cohort 3 was well prepared, had a long-term perspective, and soberly assesses the opportunities created by the current revaluation of markets. They spend a good time, or good amount of time, I hope they have a good time, exchanging views and discussing strategies with us and some of our SAB members. Still, they have concerns too. And the obvious and most significant worry for the more active investors and more investors with a long perspective is the risk of acting too soon and catching a falling knife. Another concern is the length and magnitude of the economic shutdown as we see it right now, as well as the absence of a global debt capital market and the resulting difficulty in implementing direct investments which may require some kind of leverage, and the concern about how GPs will be able to act without such a market. And finally, and probably most importantly, investors are concerned about the sequence of an eventual release of the lockdown, how this would affect certain industry, and which kind of opportunities this would create, and not to miss out of them. I believe a final remark shows that there is some light at the end of the tunnel. Having had conversations with some managers in Asia, they see, particularly from China, that most consumer brands report about their business activity being at levels of about 90% of what they saw prior to the lockdown. And I think that's what we can expect in Europe once we have a clear perspective on how the lockdown is opening up and the opportunities this creates.
Okay, thank you, Alex. Quite insightful. I'd now like to call on Rist Brouwer. Rist is a managing director in our Amsterdam, Netherlands office. Rist, help us understand how your day-to-day activities have been impacted by COVID-19 and what some of the investment partners that you're dealing with, how they're reacting and their approach.
Thank you, Clive. So next to increased involvement with our portfolio companies, given the exceptional current circumstances, I do spend a lot of time on what I think is within my span of control, which is dealing a lot with existing relationships here in Europe. So because it's simply easier to work with people you already know very well in those uncertain times. So first of all, I do have regular contact these days with management teams and in particular CEOs to let them know Silverfern is still interested in their business and to support them in these challenging times. So this has the benefit that it helps us to better know each other and to better understand their companies. Second, I do have a lot of contact with Silverfern advisory board members to make sure that they too know we are preparing for better times and that we want to continue working with them. So our SABs have a great network in often very specific industries, providing us deep industry expertise and a broader access to European businesses, which obviously is also very helpful. And then with some advisors, basically to chit-chat about what's going on currently, and also to let them know that our phone lines are open. And as requested from your question, finally, a lot of contact with financial sponsors. So some specialists in industries or in some countries, as well as some global or European private equity investors, to keep the discussion ongoing and to stay close to them, to eventually jointly invest in companies when the time and the investment case is right. Often we exchange on companies we already did take a look at in the recent past, and sometimes we discuss new ways to cooperate. As again, it's always easier to work with people you know well in certain times. So in summary, I think it's working hard to keep close to our existing networks and to prepare for what's coming.
Great. Thank you very much, Rist. I'd now like to call on Ed Rimland. And Ed is a managing director now in our New York office. And Ed, my question for you is, how is the US and specifically New York reacting from a policy perspective to everything that's going on in the market?
Thanks, Clive. I think if we step back a second, a lot of the things I'll comment, I think you're hearing some from my partners around the world, but certainly initially the United States and more specifically the New York area were slow to react from a policy perspective. Testing was slow and early efforts at mitigation really did not work. We saw continuing battles between states, cities, the federal government over things like equipment and testing, and that only made things worse. And obviously a big focus of everyone has been certainly the United States on the density of New York City. Early cases that were in the Washington area seem to have been contained fairly well, but obviously the density of New York City and the amount of community spread here has been a big focus of certainly the government in New York as well as federal authorities. After a number of weeks, it really looks like governors and local leaders have taken charge, and some of the early efforts of social distancing, which really has gone across the United States, seem to be working and have in fact flattened the curve, noting that close to 90% of the U.S. population is under somewhat or full stay-at-home orders for non-essential workers. There has been a big debate in the United States and in New York what exactly is an essential versus non-essential workers, but that's really been a sideshow. I mean, practically speaking, most, if not all, the U.S. is closed right now. The stimuluses that have occurred have been really twofold. First has been the monetary stimulus led by the Fed, and they went relatively early, lowering interest rates and acting as a buyer of last resort in a number of credit markets, which really served to stabilize those credit markets. The U.S. Fed has continued to provide liquidity to other parts of the credit markets to make sure it's working on a good way in keeping the flow of credit, cash, and capital to both businesses as well as individuals. Recently, a federal stimulus program of a very large amount, almost $2 trillion, was approved, but it's taking some time to implement. There's been a lot of systems that had to be created both to get cash to individuals as well as businesses. But it is a multi-pronged stimulus directed towards, again, individuals, smaller businesses, and larger corporations, noting that over 75% of the U.S. workforce is linked to small businesses. I think kind of looking at the data and looking at models and the success of some of the social distancing, it's pretty clear that the curve is flattened and the discussion really is beginning to move, and I would say beginning, on how do we restart the economy, the discussion on how fast things can normalize to whatever a new normal is. People are thinking about what does back to work look like, what does testing, what does surveillance look like, what do therapeutics look like, and ultimately what does the vaccine look like. But I think we will not see that for a number of weeks until we see much clearer evidence that certainly this outbreak has been controlled to the best you can right now. Beyond COVID-19, and it really also goes mentioning, we're dealing with a significant oil shock that really began to occur prior to COVID-19, has only been exacerbated by the COVID-19 drop in demand. The difficulty and the disagreements between the Saudis and the Russians certainly created a lot of downward pressure on oil prices, although as recently as an hour ago, we are hearing that it looks like there is some agreement which could firm up some oil and gas opportunities, but we continue to be circumspect on those opportunities. So I think that the message is we're all at different points of the curve. Obviously, China was early, then Europe, and then the United States, and I think we're all looking at how do we solve the health problem first, and second, how do we solve the economic problem?
Okay, thank you, Ed. I'd now like to call on Deepak Ghosh, and Deepak is also a managing director in our New York office. And Deepak, how are you seeing COVID-19 is impacting new deal activity, and what have you been hearing about the debt markets in the US?
Thank you, Clive. In March, as the COVID-19 pandemic kind of reached our shores and people realized the health crisis that is impending, the market reacted and transactions died up fairly quickly. Most auction processes were halted. Companies had to reevaluate where their earnings are going to be in the short term in the first and second quarter. And in some sectors, people understood that, such as transportation, leisure, and gaming, would be really severely impacted. We had started work on some transactions, and they have been progressing remotely and slowly. And our expectation is we will kind of slowly work through these as we see the risks on the public health side slowly decline. We focus a lot on companies and we talk to management teams, and they're also very focused on their employees, their businesses globally. They really want to keep their business safe from epidemics that might hit their companies. So that's a big concern for them. We continue to interact with these management teams as well as our sponsor partners very actively, and people are taking a positive approach, but a sort of a wait and see approach. I think the expectation is that by when the time we reach fall, that the markets would open up, the risk would be less and would be more boxed in, and the M&A demand in the market would start opening up. But I think it's sort of a wait and see game. The debt market side is very important for us. They're the bread and butter of the buyout business, and debt markets typically follow the equity market. After a very robust January and February, the term loan B and the high yield markets collapsed, followed by the equity markets, and somewhere between $15 to $20 billion worth of capital just headed for safer havens such as prime money markets. And the Fed was very good at backstopping those markets, so the money all rested there. I think everybody's waiting for, again, the same thing, which is when will the risks be boxed in? And I think when they see that, or they see a path to that, the debt markets will wake up, and they will probably first return to more higher quality credits, which is less risky. But make no mistake, history tells us that when high yield markets start opening up again, they become very, very busy. People get very active, and if the M&A side spikes up, these markets will just follow suit. Thank you.
Okay, thank you, Deepak. And finally today, I'd like to call on Mark Baldassari. Mark is a Managing Director in our Sydney, Australia office. And Mark, some similar questions for you. What are you seeing in terms of local market activity, and how's the market adjusting in a continuing and soon-to-be post-COVID new world?
Yeah, thanks, Clive. Look, down under, the Australian government has adopted what I call as a hibernation approach to dealing with the virus. In other words, a slow but steady approach to reducing the rate of infection. So that's been allowing businesses to operate as much as feasibly possible. There's been no complete shutdown of business activity. So preventing sort of a severe negative impact that could come from a complete shutdown of business activity. Added to that, the government has been invested $240 billion to stimulate the economy, really aimed at assisting businesses to remain open, in particular for employees to continue to be paid during this period, whether they're working or not. And so far, that strategy seems to be working. We're certainly seeing a flattening of the curve, and the absolute number of new COVID cases is coming down on a daily basis. In terms of deal activity, look, that has ceased for the time being. People, sponsors in particular, focused on looking after their portfolio companies and making sure that they survive through this crisis and ensuring liquidity for their investments. All processes, I think, have pretty much ceased. Unless you were pretty much about to close a deal prior to the onset of the crisis, and all those processes have shut down for the time being. Banks focused on maintaining the survival of their own borrowers. They don't really have time or inclination at the time being to consider any loan proposals, so credit markets essentially closed for the short period. We are seeing some deal activity in listed markets, through the provision of equity financing to public companies. sponsors taking advantage of severely depressed valuations at this period. I think when we get to see what I think is called the new normal emerges, I think there's going to be some considerable opportunistic buying opportunities. Good businesses that have weathered the storm relatively well, have faced some liquidity issues, going to require some support going forward. I think that's more prominent for private companies, which really don't have that access to public markets. So what we're doing here is actively working with members of our advisory board to identify the right businesses and the right sectors to really focus on come end of COVID-19. I think the key now is to prepare, identify those businesses and be ready to invest when the opportunity arises in the not too distant future.
Excellent. Thank you, Mark. Well, I think that really sums up our current view on a global basis. Silverfern has, as you've heard, an opportunistic investment strategy that we've employed now for close to 20 years. And our experience tells us that we're going to have a very busy latter half of this year and certainly into the next 2 years, identifying and then capturing the value dislocation in the current market. As we adjust to the new normal, we are going to be seeing more of those opportunities that are attractive to us. Today, in fact, we're already pursuing 3 or 4 new, attractive investment opportunities that have come about because of the asset revaluation in the market. Green shoots for sure, but the start of something good to come. So I'd like to thank the Silverfern team for their participation today, and I'd like to thank you all for joining us on this call. We will be having another webinar in another week or 2, and this will focus on our portfolio investments and the impact that COVID-19 has had on their operations once we've had a further week or 2 to fully assess that impact and what it will do on a go-forward basis. We're very much looking forward to having you join us on that call as well. Thank you.